The Bureau of Statistics data shows the pay packets of Australian workers on average have risen by 0.8% in the third quarter. That takes the annual wages increase to 3.4% in the year to September. Now that is in line with the expectations of the RBA economists and the market broadly. And it means that the annual wages growth is running just ahead of the annual inflation rate of 3.2%. Well, Ben Udy is the lead economist for Oxford Economics Australia, and he's standing by for us. Ben Udy, thank you for your time. So it seems that pay packets in Australia, if you look on an annual basis, are running just ahead of inflation.
Yeah, that's right. The 0.8% increase, as you noted, is broadly in line with what everyone was expecting, both the RBA and ourselves. But we are seeing a sort of gradual cooling in wage inflation. You have to remember these are pretty lagged data. So this relates to the September quarter, and we have more information after that period, noting that the labour market's still running pretty tight. So it's not surprising to see wage growth still running pretty hot.
You say there's a bit of cooling. Is that when you look at the quarterly inflation number versus the quarterly wage growth number as opposed to the annual picture?
Yeah, that's right. The quarterly wage growth of 0.8% is a little bit lower than inflation. I don't think these two things are directly comparable, and so it's not that one is going to force the other lower, with sort of quick succession. Over time, lower wages will reduce pressure on inflation. Even so, I think what we're seeing is a bit of a cooling in private sector inflation. In today's data, we saw private sector wage growth tick down to 3.2%. A lot of the strength in today's data was driven by the public sector. And we know from the labour market data that the government's been putting less pressure on public sector employment growth in recent months. So it wouldn't be too surprising to see public sector wage growth start to cool over the next year or so, which would lead to a slight reduction in overall wage growth.
And how does this play out in terms of consumer spending power, if you like? We know prices have gone up substantially since the COVID period, and although are moderating, wages are barely keeping pace. Yeah,
that's right. So I guess compared to a couple of years ago, it's encouraging to see wages rising faster than inflation. That means the real purchasing power of households is increasing. However, you're right to note that it's not a big difference. Part of that is because of the spike in inflation that we've seen in the last quarter, and we don't expect that to persist too long. So we do expect wage growth to be running ahead of inflation next year, and that to see households' purchasing power increase. However, it's not going to be a big windfall for households all at once. It's going to be slow, gradual gains.
So just at the margins, as you say, the labour market is pretty tight, hence why we're still seeing this wages growth. Will this feed into inflation? Does it give the RBA anything to worry about?
The RBA is certainly interested in wage growth, and because it is important for inflation. But one thing that we saw in the minutes released by the RBA yesterday is that they're actually noting that there are a lot of different measures of wage growth, and a lot of the measures of wage growth are running faster than the WPI. In particular, the WPI doesn't account for productivity changes. And the RBA has been noting that weak productivity growth means that the current pace of wage growth needs to cool even further than normal in order to get inflation back to target. So the fact that we've just received a 0.8% increase in the WPI in line with people's expectations is certainly not going to be putting any pressure on the RBA to cut rates. They'll be pretty comfortable holding rates as is for the time being.
Yeah, and yesterday the RBA minutes really raised the question of just how restrictive interest rates in Australia actually are, given the inflationary pressures. Where do you see interest rates going?
Yeah, we still see two rate cuts in 2026. We expect that, the lack of cuts that we were previously expecting will see the labour market loosen over the next 6 months or so, and that'll put pressure on the RBA to start cutting rates in 2026. However, the bank's hawkishness yesterday suggests that it's going to be a gradual approach, and they'll need to see a pretty significant amount of data before they start or resume rate cuts.
And when you're talking about next year, you're talking about the latter half of next year, I presume.
Yeah, that's right. We've got our first rate cut penciled in for May and the second rate cut penciled in for November next year. So still a way off.